Hello and welcome back to my channel, The Midlands Investor, your one-stop shop for all things investing and personal finance. Having been a passive investor now for almost a decade, I have often found myself researching and taking an interest in Warren Buffett's approach to financial investing. His story is internationally famous and often cited in many personal finance guides and textbooks. As a result, I thought it might prove useful to summarise a little bit about him as a person, his current role, and most importantly, his investment strategy. Warren Buffett is one of the world's most renowned investors and is widely regarded as a role model for those looking to invest in the stock market. His investment philosophy and strategies have been studied and emulated by countless investors over the years. Here, we will look to take a detailed look at Warren Buffett's investment strategy, how he has implemented it over the years, and why investors may choose to follow his investment approach. We will also examine the strengths and weaknesses of his investment approach and compare it with other investment strategies. So, Buffett's investment strategy. Buffett's investment strategy is centered on value investing, which involves buying companies that are undervalued by the market but have strong fundamentals and growth potential. His approach is based on a few core principles, which we will outline below. Focus on intrinsic value. One of the key components of Buffett's investment strategy is his focus on the intrinsic value of a company. He believes that the true value of a company is not reflected in its stock price, but rather in its underlying assets, earning power, and growth potential. He looks for companies that are undervalued by the market and have the potential to generate strong returns over the long term. His approach to valuing companies involves a deep analysis of their financial statements, management team, and industry dynamics. He looks for companies that have a wide economic moat, which is a sustainable competitive advantage that will protect the company's profits and market share from competitors. This could be in the form of a strong brand, a patent, or a high switching cost for customers. He believes that a company with a wide economic moat is more likely to generate consistent earnings over the long term, which will eventually be reflected in its stock price. The long-term investment horizon. Buffett also believes in a long-term investment horizon. He is not interested in short-term gains or in trying to time the market. Instead, he looks for companies that have the potential to generate strong returns over a period of several years or even decades. He is known for being a patient investor and not making hasty decisions. He believes that investing is a marathon, not a sprint, and that the key to success is to find great companies and hold on to them for the long term. Focus on management quality. Another key component of Buffett's investment strategy is his focus on the quality of a company's management team. He believes that a good management team is essential for a company to be successful in the long term, and he looks for companies that have a strong and experienced team in place. He also pays close attention to how a company is run and whether its management team has a long-term vision for the company. Buffett also puts a lot of emphasis on diversification and risk management. He believes that it is important to spread investments across a wide range of companies and industries to minimise risk. He also believes in maintaining a significant cash reserve to take advantage of opportunities that may arise during market downturns. He is known for his conservative approach to investing, and he avoids trendy or speculative investments. Buffett has been investing for over 60 years and has built one of the world's largest and most successful investment companies, Berkshire Hathaway. His long-term track record of success is a testament to the effectiveness of his investment strategy and should be something that all investors, whether new or old, should consider. One of the reasons for Buffett's success is his ability to identify undervalued companies with strong fundamentals and growth potential, as I mentioned before. He has invested in companies such as Coca-Cola, American Express, and Wells Fargo, which have consistently generated strong return over the years. He is also known for his ability to stay invested in these companies for the long term, despite market volatility and short-term fluctuations in the stock price. Buffett's investment philosophy is based upon a few key principles, which we can outline here. The first being value investing, which involves buying undervalued companies with strong fundamentals and growth potential. He believes that the market is not always efficient and that there are opportunities to find companies that are undervalued by the market. He believes that over the long term, the true value of a company will be reflected in its stock price. Secondly, the margin of safety. This means that he looks for companies that are trading at a significant discount to their intrinsic value, which provides a margin of safety in case the company's growth potentially does not materialise. He also looks for companies that have a strong balance sheet and that are not heavily leveraged with debt, which reduces the risk of bankruptcy or financial distress in the future. Third, Patience. He's willing to wait for the right investment opportunities to come along, rather than rushing into investments that do not meet his criteria. He believes that investors should not try to time the market or chase short-term gains, but instead focus on finding great companies and holding on to them for the long term. And finally, circle of competence. This means that investors should only invest in companies that they understand and have knowledge about. He believes that it is better to invest in a few companies that you understand well, rather than trying to diversify across a wide range of companies that you know nothing about. There are, however, a couple of weaknesses of Buffett's investment strategy. The first one being that it may not be suitable for all investors. For example, value investing requires a lot of research and analysis, which may not be feasible for all. It also requires patience and discipline, which not all investors may possess. Additionally, the focus on long-term investments may not be suitable for investors who are looking for short-term gains or who need access to their funds quickly. And secondly, it may not be suitable for all market conditions. For example, the value investing approach may not work as well in a market where growth stocks are outperforming value stocks. Additionally, the focus on a few key investments may result in a lack of diversification, which can increase risk. So, Buffett's investment strategy is based upon a few key principles which we've covered today, including value investing, margin of safety, patience, and circle of competence. This approach has proven to be highly effective over the years for many and has generated strong returns for Buffett and his investors. However, it is important to note that Buffett's investment strategy may not be suitable for all investors, and there are strengths and weaknesses to this approach. Investors should carefully consider their own investment goals and risk tolerance before deciding to follow Buffett's investment philosophy. And that's it. Thank you for watching once again. I've been the Midlands Investor. Don't forget to like and subscribe if you enjoyed this content, and I'll see you again next time.